the initial knee-jerk response was to see the prices go up about 13%, which was basically pricing in a complete stopping of the flow of oil through the Straits of Hormuz. But it does seem as though that worst case scenario isn't likely going to play out. Now, time will tell, of course, because President Trump has said that this is likely going to play out over 4 to 5 weeks. But so far, it does seem as though some of the tankers, they're basically deciding not to go through, not that they're actually being attacked. And so I think that, at least in a little way, is a silver lining here.
Just talk to us a little bit about the outlook for emerging markets. How dynamic is it at this point in time?
Yeah, so emerging markets are an area that we've really liked all year and even last year. And this is a little bit of a challenge if you suddenly see higher energy prices. That, of course, will affect the purchasing power of consumers and those economies, putting some under strain, but also benefiting others who are net oil exporters. So in a way, when we think about a country like, let's say, with India being a net importer, China is particularly sensitive to oil prices, especially through that area, since about 38% of the oil that goes through the straits head towards China. So I think that you do have some areas that are perhaps negatively affected by this, but others, as long as this is somewhat short-lived, I think that it should be okay for their fundamentals.
Just want to dive a little deeper into what you said about China, because there are those who believe that because China has oil reserves for months, it's the most insulated in this situation.
Well, it could be, and that's one of the things that China has done, not just with oil, but other metals as well. A good chunk of last year, it did seem as though there was a lot of hoarding going on in terms of like with copper, other metals as well. So they have taken that approach about trying to stockpile some of these strategic resources that they might need, but they will eventually deplete those. And plus, we consider the opportunity cost of that resource that they have. So the market price goes up, it reflects the value of it. And so in a way, even though they have stockpiled it, they do have to still worry about some of the pressures that could be put on the consumers if this is more protracted.
Can you paint a story of the risks for the market across AI CAPEX? And I say this because we're thinking about margin pressures right now, and they could be increasing because base metal prices, they shoot up, private credit markets start to shake up, and there is also a geopolitical impact. But just compare it to geopolitical impact, which is right now in the forefront.
Oh, I'm so glad you brought that up, because I think that is one of the things that many people aren't thinking enough about, is how AI, that buildup there, has really helped fuel the market rally over the last couple of years. And now the step back is because of this massive change in the outlook for the margins or the return on equity. So suddenly now you have an increase in energy costs. Well, we know that how energy dependent a lot of those data centers are. We've also seen in the data, in terms of the producer price index, that the cost of manufacturing those data centers is increasing. And now if the cost of financing is also increasing, this becomes almost a triple whammy for them, where you have the cost of manufacturing the facilities going up, you have the cost of running them going up, and then also the massive competition, which has been affecting margins.